President Trump signed into law the One Big Beautiful Bill, a sweeping overhaul of the U.S. tax code affecting virtually every working American, retiree, parent, and homeowner. Spanning over 1,000 pages, this legislation cements previous tax cuts, introduces brand new deductions, and reshuffles credits and exemptions in ways that could save some taxpayers thousands of dollars, while eliminating or scaling back benefits for others. This comprehensive guide breaks down the key provisions of the bill, explaining what's permanent, what's temporary, who wins, who loses, and how you might need to adjust your tax planning for 2025 and beyond. Permanent extension of 2017 individual tax cuts. One of the headline features of the new law is the permanent extension of the individual income tax rates enacted in 2017. Originally scheduled to expire at the end of 2025, the 7 tax brackets, from 10% up to 37%, will now remain indefinite, adjusted annually for inflation. This means bracket stability. Taxpayers will continue to see the same income thresholds for each rate bracket, reducing the risk of bracket creep due to inflation indexing. Future predictability. Individuals and financial planners can forecast liability with greater confidence, knowing the rate structure won't revert to pre-2017 levels. By locking in rates, the legislation aims to provide long-term certainty. However, critics argue that it significantly reduces future revenue and limits Congress's flexibility to respond to economic changes. Standard deduction and personal exemptions. Elevated standard deduction. The bill maintains the higher standard deductions introduced in 2017, indexed for inflation through 2029. Single filers, $15,700, indexed annually. Heads of household, $23,625, indexed annually. Married filing jointly, $31,500, indexed annually. Retaining generous standard deductions simplifies tax filing for millions, particularly those without sufficient itemized expenses to exceed these thresholds. Elimination of personal and dependent exemptions. Conversely, personal and dependent exemptions, which previously allowed a flat deduction per household member, remain permanently suspended. Families with multiple dependents may find that despite higher standard deductions, they lose the incremental benefit of exemptions for each child or dependent adult, potentially increasing taxable income relative to pre-2017 rules. Expanded SALT deduction, state and local tax, SALT deductions have long sparked debate, especially for taxpayers in high-tax states like California, New York, and New Jersey. Under the new statute, income under $500,000 deduct up to $40,000 in SALT payments, state income, property, and sales taxes, quadruple the previous $10,000 cap. Indexed increase. This $40,000 limit will rise modestly with inflation through 2029. Sunset provision. Unless renewed by Congress, the cap reverts to $10,000 after 2029. This expansion offers substantial relief for homeowners and high-tax state residents, particularly retirees on fixed incomes, though it leaves high earners above $500,000 adjusted gross income still limited to the older, lower cap. New senior tax benefits, Social Security deduction. Contrary to campaign rhetoric promising complete elimination of Social Security taxation, the law implements additional $6,000 deduction for taxpayers aged 65 and over, beyond the existing senior deduction, subject to phase-outs for adjusted gross income above $75,000, single, or $150,000. Married filing jointly. Temporary window. available through 2028, after which Congress must act to continue or let it expire. While the White House touts this as a major boon, projecting 90% of retirees avoid tax on benefits, analysts note that approximately two-thirds of beneficiaries already paid no tax due to low overall income, so the net impact is more moderate for many. Deducting tip income and overtime pay. Perhaps the most novel individual worker provisions in decades, the bill introduces, for the first time, the ability to deduct earned income components without itemizing. Tip income deduction. Up to $25,000 of reported tip income deductible for joint filers, or $12,500 for single filers, subject to AGI limits of $300,000 joint, $150,000 single. Overtime, wage deduction. Up to $25,000 of overtime pay deductible for joint filers, $12,500 single, beyond base salary, under the same income ceilings. Standard deduction compatibility. These new subtractions apply even to those taking the standard deduction, delivering real dollar relief directly to service workers, hospitality employees, healthcare aides, and anyone whose earnings rely on extra hours or gratuities. These groundbreaking changes recognize non-salaried labor forms and put cash back in the pockets of those who work long hours yet lack traditional itemizable expenses. Car loan interest deduction. Aimed at middle-class auto buyers, the legislation adds new vehicle loan interest, deductible up to $10,000 for interest on loans originated after December 31, 2024, for new and used vehicles. Income phase out. Begins at $100,000 adjusted gross income, see single, and $200,000 joint. While modest compared to mortgage interest, this benefit encourages consumer spending and eases financing costs, particularly relevant as auto loan rates have spiked. Family-focused changes, child tax credit enhancements. The long-standing $2,000 child tax credit rises to $2,200 per qualifying child under age 17 with full inflation indexing. Valid SSN requirement. Claimants must have a Social Security number, excluding approximately 2.7 million children of undocumented parents from eligibility. Phase-in out. Phased out for high earners, but most middle and lower income families see a direct boost. Trump accounts for children. Baby bonds. One of the most talked about features is the new Children's Savings Account program. Automatic $1,000 government seed for each child born or adopted between 2025 and 2028, funded upon account opening. Annual contribution cap. Up to $5,000 post-tax per year by parents or other parties. Tax-deferred growth. Withdrawals tax-free at age 18 for education, first home purchase, or business startup. Critics warn that lack of engagement may leave many accounts dormant, while proponents argue it plants a financial habit and eases college home buying costs. Adoption tax credit improvements. The non-refundable adoption credit becomes partially refundable, up to $5,000, and, beginning 2026, indexed for inflation, enhancing support for adoptive families. Dependent care benefits. Two key expansions help with child and dependent care costs. Employer-provided dependent care. Tax-free benefit cap raised from $5,000 to $7,500 per year. Child and dependent care. Credit. Now worth 50% of qualified expenses, up from a lower percentage, making care costs significantly more affordable. Charitable giving updates. The bill tweaks both standard and itemized charitable deductions. Non-itemizers may deduct up to $1,000 in cash donations or $2,000 married, above the line without itemizing. Itemizers must exceed 0.5% of AGI in total donations before any deduction applies. High income cap. Deduction limit reduced from 60% of AGI to 35% for the wealthiest givers. These changes aim to encourage broad-based giving while trimming subsidies for the top earners. Small business and miscellaneous deductions. Qualified business income, QBI. Minimum for sole proprietors and pass-through entities. The new law guarantees a minimum $400 deduction, provided the business earns at least $1,000 in net income and the owner actively participates. This supplement sits alongside the existing up to 20% QBI deduction, offering a floor for very small operators. Gambling and casualty losses. Gambling losses, deductible only up to 90% of reported winnings, curtailing write-offs on net loss beyond that threshold. Casualty losses, from fires, floods, or storms, only deductible if a federal or state disaster declaration applies, narrowing claims after localized property damage. Education savings and special accounts. Education-related account rules see modest but important expansions. 529 plans and ABLE accounts, now usable for tutoring, credentialing programs, and certain therapy expenses. Rollovers. Unused 529 funds may be rolled into ABLE accounts, benefiting families of disabled individuals. These changes provide greater flexibility amid rising education and care costs. Eliminated and repealed deductions. Several legacy deductions disappear or narrow further. Moving expense. Deduction retained only for active duty military and certain intelligence community employees. All others lose eligibility. Bicycle commuter reimbursement, fully repealed, ending a modest fringe benefit for eco-conscious commuters. Reporting threshold adjustments. To reduce administrative burdens on small merchants and gig workers, Form 1099K requirements rise sharply. New threshold. No longer required unless annual payment volume exceeds $20,000 and more than 200 transactions, up from $600 in prior years. Effective date. These higher thresholds apply beginning with 2026 filings. This change aims to streamline reporting for side hustles, rideshare drivers, and small online sellers. Fiscal impact and trade-offs. While the law delivers lower effective rates and new deductions across various income groups, funding these breaks adds an estimated $3 trillion to the national deficit over the next decade. To offset some revenue loss, the bill cuts Medicaid and food assistance, reductions in eligibility or funding levels for certain low-income assistance programs, scales back green energy credits, phases out or constricts tax incentives for renewable power and electric vehicles. Critics decry this as a shift of cost burdens onto vulnerable populations and environmental initiatives, while supporters argue that targeted tax relief spurs greater economic growth. The pockets of those who work long hours yet lack traditional itemizable expenses. Conclusion. The One Big Beautiful Bill represents the most sweeping individual tax code rewrite since the Tax Cuts and Jobs Act of 2017. By making key rate cuts permanent, expanding deductions for workers and families, and introducing novel benefits like tip and overtime deductions and baby bond-style accounts, the legislation aims to reward work and simplify filing. However, the elimination of personal exemptions, tighter charitable caps, and the scaling back of certain social and environmental credits illustrate the trade-offs required to underwrite these breaks. As you prepare your 2025 tax returns, it's crucial to review each of these changes, especially those temporary provisions set to expire in 2028 or 2029, and consider adjustments to withholding, estimated payments, and long-term financial planning. With this roadmap in hand, you can navigate the new landscape, seize the available opportunities, and anticipate which provisions may need congressional renewal in coming years.